By the end of 2026, China could control more gold than anyone ever imagined. Sounds odd, right? But the way China is acquiring gold from around the world, they're going all out to get as much as possible. But why is China getting this gold so rapidly? It's simple. They're doing this to shake the United States dollar. This isn't just about stockpiling precious metal. This is about challenging America's financial dominance, and gold is the tool they're using to do it. And here's the thing that should grab your attention. This isn't some conspiracy theory or far-fetched prediction. It's happening right now, backed by billions of dollars in actual transactions, official government actions, and a digital payment system that's already processing $55 billion in cross-border trade. So why does this matter to you? Because the US dollar's position as the world's reserve currency is what gives America tremendous economic power. It's why we can borrow money at lower interest rates than anyone else. It's why international trade flows through American banks. And it's why US sanctions have real teeth. But that power is being tested like never before, and China is leading the charge with a strategy that combines ancient wealth with cutting-edge technology. Let's get deep analysis on what's really going on. For decades, the US dollar has been king. After World War II, the Bretton Woods Agreement essentially crowned the dollar as the world's reserve currency. What does that mean? It means that when countries want to buy oil, when they want to conduct international trade, when they want to store their wealth safely, they've traditionally turned to US dollars and US Treasury bonds. This gave America what the French once called an exorbitant privilege. We could print money to fund our deficit without necessarily triggering massive inflation. We could impose sanctions that actually hurt because everyone needed access to the dollar-based financial system, and we benefited from constant global demand for our currency and our debt. But here's where things get interesting. As of the first quarter of 2025, the dollar's share of global currency reserves fell to 57.7%. Now, that might still sound dominant, and it is. But think about this. At its peak in the early 2000s, the dollar accounted for over 70% of global reserves. That's a significant drop, and it's accelerating. Meanwhile, gold's share of global foreign reserves has risen from around 13% in 2017 to nearly 20% by the end of 2024. Central banks worldwide have been buying over 1,000 metric tons of gold per year from 2022 through 2024. That's the longest sustained gold buying period in modern financial history. And China? China is at the absolute center of this transformation. Let's talk numbers, because the numbers tell a story that should make every American pay attention. As of September 2025, China holds $3.339 trillion in total foreign exchange reserves. That's the largest forex stockpile of any nation on Earth. But here's the kicker. China has been systematically reducing its dependence on US dollar assets, particularly Treasury securities. They've been doing this quietly, steadily, and with a clear long-term strategy in mind. At the same time, China has been on an unprecedented gold buying spree. The People's Bank of China, that's China's central bank, announced its 11th consecutive monthly gold purchase in September 2025. Their officially reported gold reserves reached 2,303.5 tons, valued at about $208 billion. But here's where it gets really interesting. Many analysts believe China's actual gold holdings are significantly higher than what they officially report. Independent estimates suggest China could be holding anywhere from 5,000 to even 6,000 tons of gold. Why would they underreport? Strategic advantage. If other countries don't know exactly how much gold you have, they can't accurately assess your financial position or predict your moves. Think about that for a second. China is buying gold every single month, month after month, while simultaneously reducing their dollar holdings. That's not a coincidence. That's a strategy. Now, let's talk about what China is actually doing with all this gold, because it's not just sitting in vaults, gathering dust. China is building an entire alternative financial architecture, and gold is at its foundation. First, there's the Shanghai Gold Exchange. Most Americans have never heard of it, but it's become one of the most important gold trading platforms in the world. The SGE operates over 20 major refineries with a combined capacity above 2,000 tons annually. In 2023 alone, China consumed 943 tons of gold, making it the world's largest consumer market. But the SGE isn't just about buying and selling gold for jewelry or investment. China is promoting it as an alternative custody location for foreign central bank gold reserves. Traditionally, most of the world's sovereign gold has been stored in places like the Bank of England in London or the Federal Reserve in New York. China is essentially saying, hey, why don't you store your gold here instead? For countries worried about US sanctions or looking to reduce their dependence on Western financial systems, this is an attractive option. You see, if your gold is stored in London or New York and you get on the wrong side of the United States, that gold could potentially be frozen or seized. But if it's stored in Shanghai, that's a different story. Second, and this is huge, China has been developing what's called Project mBridge. This is a multi-central bank digital currency platform that allows countries to conduct cross-border transactions without using the US dollar at all. As of January 2026, mBridge has processed over $55 billion in transactions across more than 4,000 cross-border payments. The platform connects central banks in China, Hong Kong, Thailand, the United Arab Emirates, and Saudi Arabia. And get this, the digital yuan, China's central bank digital currency, accounts for approximately 95% of the transaction volume on this platform. What makes mBridge revolutionary is that it cuts out the middleman. Traditionally, if Thailand wanted to trade with the UAE, both countries would convert their currencies to dollars, conduct the transaction, then convert back. That process takes days, involves multiple banks, and generates fees at every step. With mBridge, they can trade directly using their own digital currencies, settled almost instantly. The platform was originally overseen by the Bank for International Settlements, basically the central bank of central banks based in Switzerland. But in late 2024, the BIS unexpectedly quit the project. Some analysts see this as the BIS stepping away from something that's becoming too directly competitive with the dollar-based system. Now here's where gold comes back into the picture in a really big way. China and other BRICS nations, that's Brazil, Russia, India, China, and South Africa, plus several new members, have been working on something called the Unit. On December 8, 2025, the BRICS Alliance launched a working prototype of the Unit. It's a gold-backed digital trade currency. The structure is 40% physical gold and 60% BRICS national currencies, equally weighted between the Brazilian real, Chinese yuan, Indian rupee, Russian ruble, and South African rand. Let that sink in. They've created a digital currency that's directly backed by gold. Every unit is tied to physical gold reserves stored in secure vaults across member nations. The value adjusts daily based on movements in the component currencies against gold. The pilot program initially released 100 units on October 31, 2025, each pegged to 1 gram of gold. By early December, market fluctuations had adjusted the value to 0.9823 grams of gold per unit. It's still in a test phase, but the fact that it exists and is functioning is a game changer. This isn't just about creating an alternative payment system. This is about creating an alternative monetary order, one that's based on commodities and controlled by countries that have grown increasingly uncomfortable with US financial dominance. The BRICS nations collectively control about 50% of global gold production through a combination of output from member states and strategic partners. China produced 380 tons in 2024. Russia produced 340 tons. Combined, BRICS gold reserves now exceed 6,000 tons. So let's pause and look at this from different perspectives, because this story isn't black and white. From China's perspective, this strategy makes total sense. They've watched the US use the dollar as a weapon. When Russia invaded Ukraine in 2022, the US and its allies essentially kicked Russia's biggest banks out of the global financial system. Russian assets were frozen. Russian banks couldn't access SWIFT, the messaging system that facilitates most international transactions. China looked at that and thought, if we ever come into serious conflict with the United States over Taiwan or anything else, they could do the same thing to us. So reducing dependence on the dollar isn't just economic policy for China, it's national security policy. From the US perspective, this is deeply concerning. The dollar's reserve currency status is a massive strategic advantage. It allows the US government to run larger deficits than would otherwise be sustainable. It gives American companies easier access to capital, and it gives the US government enormous geopolitical leverage through its ability to impose financial sanctions. If the dollar loses its dominant position, borrowing costs would rise for the US government, for American businesses, and for American consumers. Your mortgage rates could go up. Credit card interest rates could increase. The federal government would have to pay more interest on its $38 trillion in national debt. Right now, we're already paying more in interest on the national debt than we spend on defense. From the perspective of neutral countries, countries that aren't necessarily anti-American, but aren't fully aligned with US foreign policy either, this Chinese strategy offers options. These countries might want to trade with both the US and China. They might want to trade with Russia or Iran without violating US sanctions. Alternative payment systems and alternative reserve currencies give them more flexibility. And from the perspective of financial markets and investors, this creates both risks and opportunities. Gold prices have absolutely surged. The metal crossed $4,000 per ounce in October 2025, a massive increase. Veteran analysts like Ed Yardeni are forecasting $5,000 per ounce for 2026 and potentially as much as $10,000 by 2028 if current trends continue. That's not just speculation. It's based on sustained central bank buying, geopolitical uncertainty, and concerns about fiat currency debasement. When governments print money aggressively, as many did during COVID, it erodes the purchasing power of that currency. Gold, by contrast, has maintained its value across thousands of years. Now let's get to what this actually means for you, for everyday Americans, because these big geopolitical shifts have real impacts on daily life. If the dollar weakens significantly or loses its reserve currency status, here's what you can expect. Your purchasing power gets hit. Since 2020, American consumers have lost nearly 20% of their purchasing power, according to the Bureau of Labor Statistics. If the dollar weakens further, imported goods become more expensive. That means your electronics, your clothes, your car, potentially even your food, costs more. Interest rates go up. Right now, global demand for US Treasury bonds helps keep interest rates lower than they otherwise would be. If that demand decreases because countries are diversifying away from dollar assets, the US government has to offer higher interest rates to attract buyers. And those higher rates trickle down to you. Your mortgage gets more expensive. Your car loan costs more. Credit card rates increase. The stock market gets more volatile. US stock markets have benefited enormously from the dollar's dominance and the constant flow of foreign capital into American assets. If that flow slows or reverses, market volatility increases and returns could be lower than what we've gotten used to over the past decade. But it's not all doom and gloom. These changes also create opportunities. Investors who understand what's happening can position themselves accordingly. Some are increasing their allocation to gold and precious metals. Others are diversifying into foreign currencies or international assets. The key is understanding that the world is changing and adapting accordingly. Here's where things stand as of early 2026 and where they might be heading. The dollar is not going to disappear overnight. That's important to understand. Despite all the challenges we've discussed, the dollar still accounts for about 89% of foreign currency exchanges and dominates international trade invoicing. The US economy is still the largest in the world, with deep liquid financial markets and robust institutions. In modern history, there's only been one instance of a predominant currency switching, when the dollar replaced the British pound, and that process took decades. It started after World War I and wasn't complete until after World War II. But incremental erosion is a real threat. The dollar might not collapse suddenly, but its share of global reserves, global trade, and global finance could continue declining gradually. And that gradual decline still has significant consequences for American economic power and American living standards. China's strategy is patient and long-term. They're not trying to replace the dollar next year, or even in 5 years. They're building alternative infrastructure, demonstrating that these systems work, and waiting for other countries to come to them. As more countries join BRICS, as more trade gets settled in yuan or in gold-backed instruments, the network effects start working against the dollar. The geopolitical situation matters enormously. President Trump's second term, which began in January 2025, has been characterized by unpredictable trade policies and frequent threats of tariffs. Trump has threatened 100% tariffs on BRICS nations if they pursue a currency that challenges the dollar. He's also threatened to fire Federal Reserve Chairman Jerome Powell, which would undermine the Fed's independence and global confidence in U.S. institutions. This kind of unpredictability actually accelerates the trend toward de-dollarization. If countries can't trust American policy to be stable and predictable, they're more likely to seek alternatives. You know what's ironic? The more aggressively the U.S. tries to defend the dollar's dominance through threats and tariffs, the more it might push countries toward alternatives. Technology is changing the game. Digital currencies, whether issued by central banks or backed by private entities, make it much easier to conduct international trade without dollars. The technology for alternative payment systems already exists and is being refined. The infrastructure is being built. The precedent is being set. So where does this leave us? What should we take away from all of this? First, understand that we're living through a significant historical shift. The dollar-dominated financial system that's existed since World War II is being challenged in ways it hasn't been before. This doesn't mean the dollar will collapse, but its monopoly is ending. Second, diversification matters, both for countries and for individual investors. Putting all your eggs in one basket, even if that basket is the US dollar, carries risks. China understands this, which is why they're diversifying into gold. BRICS nations understand this, which is why they're building alternative payment systems. Smart investors understand this too. Third, gold's role in the global financial system is growing, not shrinking. For thousands of years, gold has been money. From 1971 until recently, in the era of pure fiat currencies, gold's monetary role diminished. But now, driven by central bank buying and geopolitical uncertainty, gold is reasserting itself as a strategic reserve asset. Fourth, the competition between the US and China isn't just about trade or military power. It's about the fundamental architecture of the global financial system. Who controls the payment rails? Who issues the currency that everyone else needs? These questions determine who has economic power in the 21st century. Fifth, for Americans, this means we can't take our economic position for granted. The privileges that came with the dollar's dominance, lower borrowing costs, cheaper imports, the ability to run persistent trade deficits, these might not last forever. As a country, we need to think about how we maintain our economic competitiveness in a world where the dollar isn't automatically king. Here's my question for you, and I really want to hear your thoughts in the comments. Given everything we've discussed, do you think the US should be trying to defend the dollar's dominance through aggressive policies like tariffs and sanctions? Or should we be preparing for a multipolar monetary system and positioning ourselves to thrive in that new reality? There's no easy answer. On one hand, the dollar's dominance has served American interests well for decades. On the other hand, trying to maintain a monopoly through force might accelerate the very de-dollarization we're trying to prevent. What do you think? Drop your thoughts in the comments. And if you found this video valuable, hit that like button. This is the kind of in-depth analysis you won't get from mainstream news sources, and your support helps us keep making content like this. Subscribe to the channel if you haven't already, because we're going to keep tracking this story as it develops. China's gold strategy isn't going away. The development of alternative payment systems is going to continue. And the implications for the dollar, for America, and for your personal finances are too important to ignore. Thanks for watching. I'll see you in the next one.